In this video, we're going to consider the pricing of bonds when settlement is not on a coupon date. So this takes a little more work. And our goals are to learn some of the terminology of bond trading, and we're going to learn how to use Excel for the bond analytics. So in this section, we're not going to look at the exact formulas. There's some work to be done in those. They're not very hard, but they take a little bit of work. We're going to let Excel do the calculations for us. So first off, what is the settlement date? When you agree to buy or sell a bond, the transaction typically does not settle immediately. So the settlement date is the date on which the bond enters your account, assuming you're buying, or leaves your account if you're selling, and the payment for the bond leaves your account if you're buying, or comes into your account if you're selling. Now for U.S. Treasury bonds, it's typically 1 business day after the trade date. So if I trade today, and today is a Thursday, then it will settle on Friday. If I trade tomorrow, which is a Friday, it will settle on Monday. And of course, we have to take account of things like holidays and so on. But the settlement date is usually 1 business day after the trade date. So some definitions. And we're going to look at all of these in a minute. But we have accrued interest, which is the interest that is accrued since the last coupon date. We'll see how to calculate that in a little bit. We've got the clean price, which is the value of the bond without the interest that is accrued since the last coupon date. It's for $100 of principal. And then we have the dirty price, which is the value of the bond including the interest that is accrued since the last coupon date. So this is a little bit strange. When we trade bonds and we look in the market, the price that we see is the clean price. The price that we pay is the dirty price. So we see the clean price, that's the quoted price. We have to add the accrued interest, and we find the dirty price. Now the dirty price is also the present value of all future cash flows. So if I buy a bond right now that is going to pay a coupon in 2 months, I am buying the entire coupon. And that's in the dirty price. So the dirty price is the price we pay, the present value of all future cash flows, the value of the bond including interest that is accrued since the last coupon date. Now this is a little bit strange. The dirty price is the price that we care about. The clean price is the price that we're told. So we have the clean price, we're told the clean price, we add the accrued interest, we get the dirty price. Now, there are 2 main conventions within the United States. We're only going to deal with U.S. Treasury bonds here, but there's also a different set of conventions for corporates. Now, these conventions tell us a couple of things. 1, how coupon payments are calculated, and 2, how accrued interest is calculated. Now, of course, the coupon payment calculation is really important. How much money am I going to receive on the coupons? The accrued interest calculation is really important, but it's really important because there's this quotation, call it convention, which is that the price we see in the markets, the clean price, we need to know how to calculate accrued interest so we can figure out how much money we're going to pay. Excel will do our calculations for us. Okay, so first let's look at that accrued interest. So bonds are quoted at a clean price. If you're buying a bond, you get the clean price, that's what you're told in the market. You compute the accrued interest, that's a convention, and we add them together to calculate the dirty price. Now, the clean price, the accrued interest, and the dirty price are all for $100 of principal, so we have to scale appropriately depending on how much principal of the bonds we're buying. The convention for U.S. Treasury bonds is that we take the $100 of principal, times the rate divided by 2. So if it's a 4% coupon Treasury bond, it's paying 2% coupons every 6 months. On $100 of principal, that is 100 times 2% divided by, or 100 times 4% divided by 2, $2. And then we multiply by the days since the last coupon divided by the days in the current coupon period. So we need a couple of Excel functions. We need to know the previous and the next coupon date, given the settlement date that we're interested in. So there are two useful functions here. One is called coop PCD, previous coupon date, and one is called coop NCD, next coupon date. And they take 4 parameters each: the settlement date, the maturity date, the frequency, and the basis. Now for our purposes, because we're dealing with US Treasury bonds, the frequency is always 2 and the basis is always 1. If we were doing US corporate bonds, we'd use a different basis. If the bonds paid coupons not twice a year but 4 times a year, frequency would be 4, and so on. But for us, frequency is always 2, basis is always 1. So let's do an example. Consider a 4.75% US Treasury bond with maturity 15th of January 2026. The settlement date is 23rd of June 2021. So we want to know what the accrued interest is on this bond. So the previous coupon date, we can use coop PCD. We can actually just look at our bond. If we look at it for a second, 15th of January 2026, that pays coupons in January and July. 15th January, 15th July. So the previous coupon date from the 23rd of June is the 15th of January 2021. The next coupon date is the 15th of July 2021. We can use coop NCD. We need to know how many days there are between the last coupon date and the settlement date. So we just take those dates in Excel. The dates in Excel are just numbers formatted to look like dates. So if we want to find out how many days there are between 2 dates, we just take the difference. So we take the difference, 23rd June 2021 minus 15th of January 2021, we get 159 days. We look at the coupon period, 15th of July 2021 minus 15th of January 2021, 181 days. And we calculate the accrued interest is 100 times the coupon rate, 4.75%, divided by 2, times days since last, 159, divided by the days in the period, 181. The accrued interest on this bond is 2.086326. So that's an accrued interest. It's a calculation right now for $100 of principal. Now, Excel has a function, ACCR_int, which will do this calculation for you, but it has a slightly weird first 2 parameters. So the first 2 parameters in this are issue date and first interest. These are misleading names. So for issue date, we want to pass the previous coupon date. For the first interest date, we want to pass the next coupon date. So we have to calculate those using coop PCD and coop NCD. We pass the settlement date, the coupon rate, par for our purposes 100, the frequency, twice a year, basis 1 for treasuries, and we will get the accrued interest. Now, those first 2 parameters are a little strange. Accrued interest, if you put in the actual issue date and the next interest, it will calculate the accrued interest since the beginning of the bond, since when the bond was issued. As far as I'm aware, no one really cares about that calculation. So it's a little bit of a strange implementation. So you have to use the preceding and next coupon date and use coop PCD and coop NCD. Now, lots of times, if I'm doing this calculation for myself, I will embed the coop PCD and coop NCD function calls into my accrued interest calculation. It's easier to see what's going on because the formula gets pretty messy if you do those as separate function calls. Doesn't matter. Okay, so let's do another example and find the dirty price for a bond and how much we would pay to buy $400,000 of principal for a bond. So this is a 3.75% coupon treasury bond maturing on the 15th of October 2023. We see a quote in the market for settlement on the 23rd of June 2021 of 95.1199. Okay, so that's a quote in the market. That's a clean price. To To find the dirty price, we take the clean price and add the accrued interest. So we find the previous coupon date, 15th of April 2021, using Coup PCD. Find the next coupon date, 15th of October 2021, using Coup NCD. The accrued interest using ACCR int is 0.706967. So previous coupon date, next coupon date, settlement date, maturity date, 2 for frequency, twice a year, 1 for US Treasuries. The dirty price is clean price plus accrued interest, so 95.826867, which is 95.1199, the clean price, plus 0.706967, the accrued interest. This is the price for $100 of principal. The price for $400,000 of principal, we have to take that price, divide it by 100 to get $1 principal, and multiply by 400,000. So 95.826867 divided by 100 times 400,000, $383,307. To let us know, to help us understand what's going on. So when you buy a bond, you're buying a series of cash flows from the issuer of the bond. You pay the dirty price for these cash flows, or you pay the dirty price scaled by the amount of principal you're buying. And everything else is a market convention, a way to analyze the bond, something else. All you really care about is what's the dirty price of my bond. So let's do an example. We want to find the clean price, the accrued interest, and the dirty price for a 2.5% coupon US Treasury bond maturing on the 15th of August 2023 with settlement on the 17th of June 2021, given some continuously compounded interest rates. Now, these interest rates we're assuming come from the market somewhere. I'm not giving you a where did they come from. But we've got some interest rates, we've got a bond, we can find the present value. So the dirty price is the present value of $100 of principal, and we're going to use the formula present value of a cash flow equals the cash flow times e to the minus RT. That's the present value using continuously compounded rates. And I can set up a little table in Excel or whatever. 15th of August 2021 is 59 days from the settlement date. There will be a cash flow of $1.25. It's a 2.5% coupon bond, 100 times 2.5% divided by 2. So there's cash flow of $1.25. We multiply that $1.25 times e to the minus RT. T is 59 over 365. R is from the table on the previous slide. Multiply it out, $1.2460. There's another cash flow of $1.25 on the 15th of February 2022. Do the same thing. Another cash flow of $1.25, same thing. We go through until the maturity date of the bond, 15th of August 2023. We get the coupon, $1.25, plus the principal, 100, so we get back $101.25. Again, we look up the rate from the previous table, take the 101.25, multiply by e to the minus r, 789 over 365 is the time, we get 96.3392. Add them all up, we have a price of 101.24. That's the dirty price. That's what we would pay for all of those cash flows. In order to find the clean price, we take the dirty price, subtract the accrued interest. The accrued interest, we can use Excel, ACCR int. That takes the previous coupon date, 15th of February 2021, next coupon date, 15th of August 2021, settlement date, 17th of June 2021, par, 100, frequency 2, it's a semi-annual bond, basis 1, it's a treasury. So the accrued interest is 0.8425. The clean price is the dirty price minus the accrued interest, 100.3978. I would quote 100.3978. Right, so I tell somebody else the clean price, they pay me the dirty price. So in practice, one does not look at bonds using different interest rates for each cash flow. Instead, one uses the bond yield. So this is the semi-annual interest rate that gives the correct clean and dirty prices for the bond. When comparing two bonds, the yield is a better indication of value than price. So for example, two bonds with the same maturity but different coupon rates might have the same yield but very different prices. And as they have the same yield, they both provide similar value in the market to buyers or sellers of that bond. But the different coupon rates mean they have very different prices. And so it's difficult to look at bond prices to determine value, and one typically looks at bond yields. Now, in practice, every market has specific simplifications to the calculation that allows one to compute prices from yields more easily. Unfortunately, to reproduce the calculations, you need to know the simplifications, which means you need to understand the very nitty-gritty details of the market. Rather than learning these conventions, we're going to let Excel do our work. So the function price in Excel takes a yield and calculates the clean price. The function yield takes the clean price and calculates the yield. So we have clean price to yield and yield to clean price functions. So the price function returns the clean price of the bond for $100 of principal as usual. Parameters are settlement, maturity, rate, yield, redemption, which we're always going to use 100, frequency, which is always going to be 2, and basis, which will be 1 for U.S. Treasuries. The yield function returns the yield of a bond. Its parameters are settlement, maturity, rate, price, redemption, frequency, and basis. So again, redemption is always 100 for our purposes. This takes the clean price and converts it to the yield. So we can do yield to clean price. If we consider a 3.75% coupon treasury bond maturing on the 15th of February 2030, for settlement, 23rd of June 2021, the yield is 4.5%. If we want to find the clean price, this is straightforward. We use the Excel function price. We pass settlement date, 23rd June 2021, maturity date, 15th of February 2030, coupon rate, 3.75, yield, 4.5, principal or par, 100, frequency 2 for semi-annual, basis 1 for U.S. Treasury bonds, and we find a price, a clean price, 94.672395. If we were quoting in the market, we would quote this price. Now notice the yield is greater than the coupon rate, so we have to earn more than the coupons on this bond. We earn more. How do we earn it? We earn it through capital appreciation. We pay $94.67 today, and over the next, 9 years, we get 3.75% coupons, and our bond price is going to appreciate because effectively we get back 100 at the maturity of the bond. So this bond's trading at a discount. We can convert yield to dirty price. This is a little more involved. So let's look at a 4% coupon treasury bond maturing on the 15th of November 2025. For settlement on 23rd of June 2021, the yield on this bond is 3.25. We want to find the dirty price. So what do? Calculate the clean price using the price function. Settlement, maturity, coupon, yield, principal, 100, frequency 2, semi-annual, basis 1, U.S. Treasuries. So we find the clean price, 103.045354. Calculate the accrued interest. In order to calculate accrued interest, we need the previous coupon date and the next coupon date. Accrued interest, ACCR int, previous coupon date, 15th of May 2021. Coup PCD will calculate that. Next coupon date, 15th of November 2021. Coup NCD. Settlement date, 23rd June 2021. Coupon rate, 4%. Par, 100. Frequency 2. Basis 1. 0.423913. We add them together, 103.469267. So we can take a yield, calculate a dirty price by adding in the accrued interest to the clean price. We can take a clean price and go to yield. Consider a 3.5% coupon treasury bond maturing on the 15th of January 2023. For settlement on the 23rd of June 2021, the clean price, quoted price for the bond, is 102.013776. What is the yield? We use the Excel function yield. 2.1800% is equal to yield. Takes the settlement date, the maturity date, the coupon rate, the clean price, par 100, frequency 2, basis 1. So basically, Excel gives us easy to use functions to get between clean price and yield, or yield and clean price. And then if we want something else, we've got to do some calculations like the accrued interest to get the dirty price. Finally, we're going to talk about duration. There are two kinds of duration, modified duration and Macaulay duration. And we can compute these using Excel. Now, we're not going to work through the mathematics here, but we know the modified duration is the opposite of the relative rate of change of the present value. The relative rate of change of the present value is the derivative of the present value with respect to yield divided by the present value with respect to yield. So, negative PV prime divided by PV. The Macaulay duration is the modified duration times 1 plus y over 2. That Macaulay duration has a bit more of an intuitive interpretation. Macaulay duration is when do you receive, the time at which you receive the average present value. So you take the time-weighted present values, divide it by the present value, and you find out when do you receive the average present value. Usually, it's a little bit less than the maturity of the bond. If the maturity of the bond's really long or interest rates are high, it'll be quite a bit less. But for a 4, 5, 6 year bond, it's going to be a little bit less than the 4, 5, or 6. Okay, the Excel functions we're going to use, modified duration is calculated using M duration, and Macaulay duration is calculated using duration. These take parameters, the settlement date, the maturity date, the coupon rate, the yield, the frequency, which will always be 2 for semi-annual bonds, and the basis, which will always be 1 for U.S. Treasuries. We can estimate the change in present value using duration through the formula dPV equals negative PV times the modified duration times dy. So this is our standard differential equation, which would normally look like dPV equals PV prime dy, and then we substitute in the definition of modified duration and we get this formula. We can use Macaulay duration. Remember, the Macaulay duration is the modified duration times 1 plus y over 2, so we simply divide the previous formula, or we substitute Macaulay duration in to the previous formula and divide by 1 plus y over 2, and everything works. Okay, so we're going to do one last example here. Consider a 5% coupon treasury bond maturing on the 15th of May 2027. For settlement 23rd of June 2021, the yield on this bond is 4%. We want to know what the modified duration is, the Macaulay duration of the bond, and then we want to estimate the change in present value on $800,000 of principal of the bond if the yield goes from 4% to 4.25%. So we use Excel, modified duration, we use the M duration function, settlement date, maturity, coupon, yield, frequency 2 for semi-annual bonds, basis 1 for U.S. Treasuries, we get a modified duration of 5.0724. Macaulay duration, get rid of the M in the previous formula, just plug it into duration. Settlement date, maturity, coupon rate, yield, 2, it's the frequency, twice a year, 1, the basis for U.S. Treasuries. So Macaulay duration is 5.1739, which is, of course, 5.0724 times 1 plus 0.04 over 2, so yield over 2. To compute the change in present value, we need to find the present value of the bond. The clean price, we use price, and we get 105.200632. The accrued interest, we use ACCR int, and we get 0.529891. That gives us a dirty price, clean plus accrued, of 105.730523. The dirty price is the present value of $100 of principal. We have $800,000 of principal, so we take the dirty price, divide by 100, multiply by 800,000, we get 844. And then our expected or estimated change in present value is negative present value times modified duration times the change in yield, 0.0425 minus 0.04, or we expect to lose $10,726 if interest rates go up from 4% to 4.25%. We could have used the Macaulay duration formula, where instead of putting 5.0724, we put in the Macaulay duration, but then we divide by 1 plus 4% divided by 2, and we end up in exactly the same place. So duration, modified duration, and Macaulay duration are going to show up. They show up all the time in the markets. If you look at a mutual fund, they will tell you the modified duration or the Macaulay duration of the portfolio. And you can use that to estimate how much money you might lose or make if interest rates change.